Good evening, friends. Welcome to the latest edition of Passive Speak. Today, we will be covering the HDFC Nifty 200 Momentum 30 Index Fund. This is a new fund offer which will be launched on the 9th of Feb and will be open till the 23rd of Feb. And we will cover some of the aspects of this product in the coming hour. So momentum index strategy is a part of a smart beta investing strategy, wherein the normal ETF and index fund products are based on the market cap weighted indices. Over here, basically we are looking at selection of stocks based on a rule or a factor, and hence this is what you call. It is called smart beta investing. So the idea is to provide better risk adjusted returns than the normal market cap weighted indices, and it is a rule based strategy which will be used in smart beta investing to kind of construct the index. This is backed by extensive research, and this is smart beta investing is becoming increasingly popular globally. In 2018, the total assets under management for smart beta investing were $610 billion. And over the last 5 years, it has grown at a compounded annual growth rate of 16% to $1.28 trillion in AUM. So today's topic or the smart beta factor is momentum. Now, momentum is involves selection of stocks based on the momentum factor rather than the market cap factor, which is commonly used for indexes like Nifty 50. Now, this Nifty Momentum 30 index basically selects 30 stocks from the universe of Nifty 200 based on the normalized momentum score. Now, when we say momentum, what are we referring to? Basically, we are referring to the positive movement in price. And this is a passively managed product. There is an underlying index of NSE, which is the Nifty 200 Momentum 30 index. The fund will aim to replicate this index. The selection of stocks will be basically whichever have the highest normalized momentum score. What are the inputs or variables which will determine what is the momentum score? So we have a 6-month price track record and a 12-month price track record. Both these time periods will be used to identify these stocks, and these would be divided by the standard deviation to arrive at a momentum score. So the advantage of the Momentum 30 strategy is that it keeps changing with changing market conditions. And as you know, the winners keep changing in the market. There is a rotation in sectors, there is a rotation in stocks, there's a rotation across the market caps, which happens. So the winners keep changing. So this strategy helps us identify the winners, and it will eliminate the ones which are not doing well. Historically, we have seen that this strategy has generated higher returns than the Nifty 200 total return index. So, what is momentum? Basically, what this strategy does is that it selects the top 30 stocks from the Nifty 200 index based on the normalized momentum score. And why? Because this momentum index adapts to changing market conditions, as at different points of time, different stocks across different sectors keep may do well, basically depending on macro factors, on micro factors, which may be specific to that sector or that company, or even macro factors which are what you call specific to the economy, the interest rates. So all these things take into account, which then decide which are the businesses which will do well and which are the businesses which will not do that well. And basically, the idea is that if there is a positive momentum in the price of the underlying stock, then this will persist. And as I had said, the universe is the Nifty 200, which is a combination of large and mid cap stocks. So the top 100 stocks are large cap stocks, the next 100 are the mid cap stocks. The other criteria for shortlisting such stocks is that they have to be stocks which are in the F&O segment, the futures and options segment of NSE, and they should be listed for more than 1 year at least to be eligible to be selected from this universe. And in the selection process, as I had said, that we look at the 6 month price return and we look at the 12-month price return, and 50% allocation is given to each of these price returns. And then this is adjusted for volatility by dividing this by the standard deviation. When we do this, we arrive at the top 30 stocks which have the highest normalized momentum score. There is also a cap at lower of 5% or 5 times the free float market cap. And this index is rebalanced twice a year, once in June and once in December. So if one were to look at an example of how this works, is that you have these 5 stocks which we have what you call taken as an example. Please bear in mind, this is not the exact formula, but this is a starting point in explaining to you how, in a simple way, how the stock selection happens for this index. So if you have these 5 stocks, A, B, C, D, E, you look at the price returns over 6 months and over 12 months. Over 6 months for stock A, the stock price has given a return of 30%. Over 12 months, the stock price has given a return of 60%. The standard deviation for this share price is 17%. So the momentum ratio for 6 months is 30 divided by 17, and for 12 months is 60 divided by 17. So you are arriving at 1.8 and 3.5. So if you give 50% weightage to what you call the 6 month momentum ratio and 50% to the 12-month momentum ratio, you will arrive at a score of 2.6. For stock B has a 6 month return of 20% and a 12-month return of 30% and a standard deviation of 25%. So you have arrived at a momentum ratio of 0.8 for 6 months and 1.2 for 12 months. And the average for both is 1. Similarly, for stock C, which has given a return of negative 15% over 6 months, negative 45% over 12 months, and it has a standard deviation of 21%. The 6 month momentum is minus 0.7, and for 12 months, it's 2.1. So the momentum ratio is 0.7. For stock D, it is the returns are 10% and negative 15%. The standard deviation is 28%. And the 6 month score is 0.4 and negative 0.5. So you have a momentum ratio of negative 0.1. So now when we look at the chart and we see the stocks A, B, C, D, E, so we will definitely select the first 2 stocks as they have the highest momentum score of 2.6 and 1. So this is the way that the shares are shortlisted from this 200 index. The top 30 such stocks will form part of the index. Another point which we feel is something worthwhile to notice is that in different market conditions, different stocks do well. So if you look at the sectoral breakup of this index over the last 5 years from 2019 to 2023, you will notice that there are certain sectors where the weightage has gone up. There are certain sectors where the weightage has gone down. So it may or may not hold true that the same sector will continue to do well over a longer time frame. And so the winners keep changing. So as you can see in the chart, we can just, I'll take you to the next chart. So in December 20, the Nifty IT index gave a return of 50.5% over 6 months and gave a return of 37.2% over 12 months. And in 19, if you look at the earlier chart, the Nifty IT index is a very, very small portion of the index. But in the next year, because of the positive return over 6 months and 12 months, the weightage to IT has gone up to 16.5%. Similarly, in the healthcare index, the return over 6 months is 21.2%, and over 12 months, it's 42.5%. So the weightage was 7.8% in 2019, which has gone to 24.1% because of the positive price return. In the next row, we have the Nifty Financial Services Index in December 2022. Wherein the 6 month return is 20.8% and the 12-month return is minus 0.5%. So if one looks at it in 21, the financial services weightage was only 10%, which has gone up in 2022 to 30%. And in December 22, if one looks at the Nifty IT index, it has given a return of 15.8% over 6 months, but it has given a negative return of 14.8% over 12 months. So if one goes back to the chart, the IT allocation has come down dramatically from 30.7% to a very small allocation because of the fall in the returns of this particular stocks in this sector or this index. So basically, this is what I wanted to discuss in the first half of the strategy, where we spoke about the momentum factor, which is a smart beta based strategy, and the 6 and 12 month price returns and the risk, which is measured by a standard deviation, are taken into account to shortlist these 30 stocks. Now I'll hand it over to my colleague Shikhar, who will take you through the index, the underlying index, and what are the constituents of the index. Over to you, Shikhar.
Yes, thank you, Sandeep. So yes, so as Sandeep has taken us through the theoretical parts, of momentum, what is the basic concept, how the strategy is dynamic. I'm going to spend some time now taking us into, if you were to actually subscribe to this NFO, what kind of stocks would you get exposure to? What is the sector breakup, so on and so forth. So if we look at the current slide, we can see, the top 10 stocks and their weightages are given in this table on the right side. So there are many, recognizable names here. Even in the top 10, you can see there's quite a bit of diversity in terms of sector distribution. Plenty of auto names, some amount of financials, industrials, pharma. So you can see that the top 10 itself is already quite diverse in terms of sectors. If we go to the next slide here, what's becoming even more evident is how, as Sandeep mentioned, winners keep changing among sectors, among stocks, and even among size segments. So sometimes, large caps do well, sometimes mid caps do well, sometimes both are doing well. And we can see here that right now, because the parent index consists of both large caps and mid caps, and performance has been relatively strong across the board. The current portfolio happens to be, split exactly in half between large caps and mid caps. So as a result, 15 stocks in the current portfolio are large cap, 15 are mid cap. It's worth bearing in mind that this number or this split between large and mid is going to keep changing through time. Again, this strategy is very dynamic. As and when, one segment tends to do better than the other, the strategy will readjust and tend to buy more stocks of that segment. Right now it's 15-15, but please bear in mind that this can change, from the next rebalance or a few rebalances. Hence, it's all about the dynamism of the underlying strategy. I think many of you will also have questions on the weightages. So at the moment, while 15 stocks are large cap and 15 are mid cap, in terms of weightages, the large caps are about two-thirds, so about 67% weight, and all the mid caps together, they are about 33% weight. So you have the distribution here between number and also weight. Finally, it's also very useful to see what is the difference between this index, which is your Nifty 200 Momentum 30 index. How is it differing from its parent index of Nifty 200? So if you were to invest in this index fund, you'll see that the sector weights of capital goods, auto, healthcare, these three sectors in particular are much more than their corresponding weights in the Nifty 200. So capital goods is a very sort of striking example, because in the momentum index, it has almost 17.2% weight, whereas in the Nifty 200, it has only 3.1% weight. So right now you have 14% additional weight in the momentum 30 index compared to the parent. Um, if you look at, on the flip side, for every overweight, there must be a corresponding underweight. So in this case, the momentum index is significantly underweight the financial services and currently even the IT sector relative to the benchmark. So, as you are aware, some of the large stocks in the financial sector have not been doing that well. And as a result, the momentum strategy has shied away from including them. It has instead gone with the stocks which have had a better 6-month, 12-month performance. And that's why you are seeing its overweight, stocks in sectors of capital goods, auto, healthcare, but correspondingly underweight IT and financial services. Again, it's worth bearing that this is just the portfolio weights as of the latest rebalance with December and updated as of Jan. In 6 months, this could be different. Again, if the underlying metrics change, the portfolio will also be dynamically adjusted. But the main point of this slide is to show you that you are getting significantly more exposure to certain sectors like cap goods, auto, healthcare, significantly less than others as compared to your normal beta indices like Nifty 200, Nifty 50, so on and so forth. So that is the main takeaway from this slide. Okay, so now that we've got an idea of what the current index and the portfolio looks like, let's look how the strategy has performed historically. So it's pretty clear that the strategy has had very good performance over different time frames. Over practically every time frame that we have analyzed here, it has beaten both its parent index, the Nifty 200, and also the Nifty 50. So just to give you an example, over the last 3 years, this strategy, the underlying index has given you 31.2% CAGR. Correspondingly, Nifty 200 is 20 and Nifty 50 is 18%. So in the short, over these different time periods, the Nifty 200 momentum index has definitely had a very strong outperformance. Even if we look at it on an FY basis, right, which gives a little more granularity into which years the strategy did well and which years it didn't, we can see that out of the total of 18 financial years considered, this strategy has outperformed the parent Nifty 200 or even the Nifty 50 index about 73% of the time. So 13 out of 18 years, clear majority of the times, at least historically, this strategy has beaten its parent index. And the years where it has underperformed, which we've marked here in red. So for example, financial year 7, 10, 19 and 23. We've also given some amount of we've also explained what kind of market situation was prevailing at that time. So it's important to realize with this strategy that very often it goes through a period of strong outperformance. Then, as and when the market winners change, this strategy also adjusts to the changing leadership. So it's possible while the transition is happening that there is some degree of short-term underperformance. But once the new trends are in place, by then this strategy has adjusted and it is in a good position to take advantage of the new trends as well. So there are periods of underperformance. No strategy is perfect, but as you can see, if you hold it with a long enough time horizon, the odds of your outperformance over the Nifty 200 and 50 are quite high, judging by history. Finally, on returns, this is also, we are just going to briefly discuss rolling returns. So this gives you a more balanced picture of how frequently or by how much on average this strategy has outperformed the Nifty 250. Once again, we can see that when we purely look at average rolling returns over 1, 3, 5, 10, the momentum index has got higher average rolling returns over the 250. That means that on of all the 5-year return periods that one could consider from 2005 up till today, on average, the Nifty 200 index has given you higher returns than the 250, right? So in terms of rolling returns, the story is very clear. Over these different horizon periods, the momentum index has outperformed. But one thing we should note is, as I was mentioning earlier, that this strategy does come with higher risk than the Nifty 200 or 50. Reason is A, it is a 30 stock index, and B, because sometimes trends can reverse quite abruptly, the strategy can also underperform in the short term. So while on a historical basis you are getting higher returns, do note that the standard deviation of these rolling returns is higher than the 250. Um, so that's the basic point of this slide. And I would just conclude by saying that if we look at the return risk ratio, which is basically taking in the returns, comparing it to the standard deviation, still, the momentum index is coming on top historically. So despite the higher volatility, it has given you higher returns to sort of compensate for that. And as a result, you can again see here in the return risk column that the return risk ratio is definitely green, which means it is the best compared to the other two. So that is, just to give you an idea of the rolling returns, the sort of consistency. Again, your, odds are of outperforming the Nifty 200 or 50. They are going up with time. So this is one product to consider for the long term, despite the potential underperformance you may experience in the short term from time to time. So with that, again, I would conclude and give it back to Sandeep to summarize and yes, to summarize. Thank you.
Thanks, Shikhar. So we'll just kind of summarize the last few slides. So why invest in the HDFC Nifty 200 Momentum 30 Index Fund? Because of the growth potential, as the fund endeavors to provide better risk-adjusted returns than a plain vanilla market cap weighted index. And the Nifty 200 index is also a very popular index because of the broad-based rally across market caps. So it's a mix of large and mid, the Nifty 200 index. The strategy for stock selection is rule-based and transparent. The weightage is disclosed and it's known. And the strategy is dynamic as there is a rebalancing which happens twice a year in June and December. And going by this strategy, you are able to pick the winners which keep changing and the stocks which cease to have momentum or positive momentum. There is a process of elimination by which those stocks are then eliminated from the shortlist and new stocks are added which have a positive price momentum. Being an index fund, this is a low expense product, so it's an ideal vehicle for long term investment as the recurring cost is very low. So this fund is suitable for those investors who are looking at a low cost index exposure to the momentum factor, and their aim is to outperform the broad market index, and they have a basically a higher risk appetite or a higher tolerance for volatility which they may experience in the shorter periods of time because uh, the stock the stocks can exhibit negative return and then they be eliminated from this particular index. And the key risks in this particular product are that they are based on the stock selection is based on the recent performance of the stocks, that is a 6 and 12-month periods, these recent trends may or may not sustain in the future. The trends may reverse abruptly also, which can impact the performance in the short term until the portfolio again adjusts to the new market conditions. And what we have seen is that historically the volatility is more in the returns is more than the normal broader indices like the Nifty 200 and the Nifty 50. The sectoral concentration can also be higher because if, as we had seen that if a particular sector is doing well and there are more stocks in that sector in that particular index, they would then all be naturally selected in that 30 stock index as compared to broader markets. And these were briefly some of the risks. It's not an exhaustive list. So HDFC AMC, the key strengths for us, basically we've been in this business of managing index funds for now over 20 years. And we are a trusted name in the financial services, what you call world and in mutual funds specifically. We have a very wide product range. We have 19 ETFs, 17 index funds and 3 funds of funds. So we have market cap based ETFs and index funds. We have sector-based ETFs, and we have 5 smart beta products and 2 index funds. In commodities, we have 2 ETFs and 2 fund of funds. In the debt side, we have 8 index funds and 1 ETF. And on the international side, we have 1 fund of fund. We have leadership position in the market cap based index funds. We have a fairly big size and a long track record in commodity ETFs like our gold ETF. And we have unique products like the small cap ETF. We are the only one in the industry with a small cap ETF. So this will be an open-ended scheme which will be tracking the Nifty 200 Momentum 30 index. The idea is to replicate this index and give returns in line with the index, subject to the tracking error. And this new fund offer is opening on 9th and closing on the 23rd. Purchase and additional purchase can be made for 100 rupees and any amount thereafter. And to summarize, one can say that we've all heard the story of the hare and the tortoise, and that's an Aesop fable where the tortoise wins the race because he's slow and steady. So this particular fund strategy is a little counterintuitive, where we chase the hare and we go for the basically we are looking at stocks which are generating positive price momentum over 6 months and 12 months, and hence we try to identify the winners and invest in them. And we are so happy that you all could participate and join us in this. And we hope that you would consider this fund for investment. The new fund offer opens on the 9th of Feb, that is this Friday, and it will be closing on the 23rd. And look forward to your participation in many more such sessions in the times to come. So thank you, Shikhar. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.